Welcome. This week, Taiwan Semiconductor Manufacturing, or TSMC, posted its highest monthly revenue on record, fueled by a relentless surge in demand for artificial intelligence chips. The market reacted, sending the stock up 5% in a week where the broader S&P 500 was flat. But as the company announces a massive global expansion and faces complex geopolitical pressures, is this AI-driven boom sustainable, or are we watching a giant stretch itself too thin? Let's break down the signals. You're listening to TickerWatch News for TSMC, Week 7, 2026. This is the weekly podcast that filters out the noise and focuses on the news and financial developments for Taiwan Semiconductor Manufacturing Company. Looking at the week's trading, it was a strong one for the company. The stock began the week around $349 and closed near $366, marking a gain of approximately 5%. This performance continues a powerful trend, with the stock up 12% over the last month and more than 81% over the past year. The trading activity stands in contrast to the broader U.S. market, which has been mostly flat for the year. However, it aligns with a stronger trend in Asian markets and the semiconductor sector as a whole, which is projected to see historic sales growth in 2026. The takeaway is that investor enthusiasm for AI continues to lift key players like TSMC, even when the wider market is hesitant. Top news and headlines. The biggest story driving the stock was the announcement of record-high monthly revenue. Sales for January jumped nearly 37% from a same month a year ago, a surge the company directly attributes to demand for advanced AI chips. This isn't just a small beat, it's a signal that the AI infrastructure build-out is accelerating. Management has raised its revenue growth guidance for the year into the mid-30% range, reflecting confidence that this trend has momentum. Alongside record revenue, TSMC is making major moves to expand its global manufacturing footprint. The company confirmed plans for new facilities in Japan, Germany, and the United States. Significantly, the company announced its second plant in Kumamoto, Japan, will produce advanced 3-nanometer chips. This is an upgrade from previous plans and places Japan at the forefront of cutting-edge chip production, a move backed by the Japanese government. This global expansion aims to diversify production and bring manufacturing closer to key customers. These expansion plans are supported by a new trade agreement between the United States and Taiwan, finalized on February 12th. The deal reduces U.S. tariffs on Taiwanese goods from 20% to 15%, improving the company's competitive position against rivals in South Korea and Japan. The agreement also formalizes Taiwan's commitment to invest heavily in U.S. manufacturing, including TSMC's previously announced plan to invest $165 billion in its Arizona facilities. However, this global diversification comes with geopolitical nuance. While TSMC is expanding abroad, Taiwanese officials have publicly pushed back on U.S. calls to relocate as much as 40% of the island's semiconductor capacity. Taiwan's top tariff negotiator called the idea impossible, emphasizing that while the company will expand its presence in the U.S. and other regions, its core research and manufacturing will continue to grow in Taiwan. Market reaction and investor sentiment. Wall Street analysts reacted positively to the week's developments. D.A. Davidson initiated coverage with a buy rating and a $450 price target, citing what it calls a compounding execution moat in leading-edge manufacturing. Other firms, including Barclays and Morgan Stanley, also raised their price targets, pointing to strong gross margins and rising AI demand. The consensus analyst price target now sits around $425. On the institutional side, fillings from the fourth quarter of 2025 showed at least one major investor trimming their position. Frank Sands of Sands Capital Management reduced his firm's stake by over 26%. While this sale occurred last quarter, it provides a counterpoint to the otherwise bullish sentiment seen in recent analyst upgrades. Overall, the news narrative has been overwhelmingly positive, with headlines focusing on the AI-driven demand boom and record sales. The stock's price action this week, a gain of 5%, was in direct alignment with this bullish news flow. Technical and fundamental check-in. From a fundamental perspective, this week's news reinforces the company's growth story. The surge in AI-related revenue provides a strong justification for its aggressive capital expenditure plan, which is projected to be between $52 and $56 billion for 2026. Even with its recent stock price rally, some valuation metrics remain compelling compared to peers. The company's price-to-earnings ratio is around 29.9, which is below the semiconductor industry average of about 43. However, some valuation models, like Simply Wall Street's, suggest the stock may be overvalued based on discounted cash flow, while also flagging a high level of non-cash earnings as a risk worth monitoring. This suggests that while the growth story is strong, investors are weighing it against a valuation that has run up significantly. What to watch next week? Looking ahead, the most significant catalyst for the sector is NVIDIA's quarterly report, expected after the market closes on February 25th. As a primary customer, NVIDIA's results and guidance will provide a crucial read-through for demand at TSMC. Investors will also be monitoring for any further details on the execution of the new fab projects in Japan, Germany, and the US, particularly regarding timelines and costs. 3 scenarios seem possible from here. In a bull case, continued positive sentiment from the AI sector, reinforced by positive results from NVIDIA, could push the stock towards the consensus analyst target of $425. In a bear case, any signs of slowing AI spending or reports of execution delays at the new global fabs could lead to a pullback. The base case is for the stock to consolidate its recent gains as the market looks for the next major catalyst. Thank you for tuning in to TickerWatch. The information in this podcast is for educational and informational purposes only and is not intended to be financial advice. If you found this episode helpful, please consider subscribing and leaving a review. Sharing the episode is another great way to support the podcast.